we have the capability now for you to maintain ownership of those assets and reflect that value with the counterparty so that you're mitigating a lot of that counterparty risk. There's still exposure on things, right? But at the end of the day, you want control of those assets and visibility on them. And if they're being rehypothecated or, a bunch of the stuff that's been done in the past, you would like to be aware of that. So I think a lot of people, they don't even know that those things exist. They think that they're going to have to give up their assets in order to generate a return.
The role of institutional investors. As we know, there's been the recent run-up in prices. People are attributing that largely to institutional investors. And I guess I would just, looking over the past few months, if each of you could just tell us a little bit about some of the shifts you've seen on the institutional side, like how they're investing in crypto. Are more of them investing in crypto? What's the vibe?
Yeah, well, in regards to wealth, I would say the institutions, there's two blocks. There's the allocators, and then there's those who want to establish themselves as a service provider, whether they're asset managers, banks, or others. We're seeing a big shift since the Trump election globally. We partner with people across the world, US, Canada, overseas, and the dynamics have changed to a point where they're looking for expertise and ways to provide wealth services around crypto for their clients on the TradFi side. So there's been a big uptick. Like I know the past few cycles, there's been discussions of institutions are coming, and some have, but this cycle is real. We're seeing real capital coming from the sovereigns, real capital coming from the large allocators, and now the service providers, the banks, asset managers, looking to get into the game for real. And this will all be being deployed between now and the next 6 to 8 months.
Yeah, I completely agree with that statement. We're seeing multiple RIAs reach out to us. Prominent RIA, we manage digital assets exclusively, working our way into TradFi. But family offices, many other institutions are looking to make large allocations to this asset class and looking for the right way to do it. And I think, after things transpired in 21 with the way not to do things, we've got a lot of people here today explaining how to do it the right way. Segregated, bankruptcy remote, insured, institutional custody. You've got, large allocations for these ETFs and treasury companies coming online. More and more, you're going to see products rolled out. These two gentlemen next to me have a lot of products that they've rolled out to the market for retail and other institutions to come in. So, yeah, I think we're just at the beginning of it.
Yeah, so for DeFi Technologies, we kind of see things on two fronts, one in North America and in Europe, since we operate in both. Our primary subsidiary issues structured products, exchange-traded products on European exchanges. And then we have a listed equity here in North America on the NASDAQ and Cboe Canada. But there were two big moments, I think, for institutions and institutional adoptions that really propelled this industry forward over the last year and a half. One was the initial launch of the Bitcoin ETFs here in the United States. And we saw an influx of inflows into a lot of our products. Of course, you saw a ton of inflows into those ETFs, the most successful ETFs in the history of any ETFs. And then the second was the Trump election. And that just legitimized that, okay, we're going to have a crypto-friendly administration, and the US is going to open up to not just Bitcoin, but all of the other digital assets as well. So then, again, we saw another increase in adoption and inflows into products into Europe, and then obviously, like we're a listed company, we're an equity here in the United States, and before Trump got elected, a lot of the institutions wouldn't even take conversations with me or CEO of DeFi Technologies, and now they're looking for exposure to the space. So we're getting meetings now, fortunately.
Great, thank you. And so, as I told the panelists, I'm just going to ask some questions. Answer if you want. You don't have to all take turns. I want to follow up to that, though, just on the whole Trump election thing, because there wasn't actually a regulatory change. It was more of a vibe shift, correct? Right. So I think that's really interesting because in other countries, there are, for example, like in Korea, there's a so-called like shadow ban on institutional investment. There wasn't anything like that in the U.S., right? It was just more people felt there was a vibe shift. I mean, is that correct? I mean, there was nothing that was like prohibiting institutional investment before, and there was nothing that explicitly allowed them when Trump took office. It was just more of a feeling that, like, just a different atmosphere.
Well, I mean, specifically for crypto equities, and especially a lot of us who were on the OTC markets here in the United States, the SEC was effectively blocking us from listing onto the NASDAQ. As soon as the new SEC came in, we were listed on the NASDAQ within a couple of weeks.
Interesting.
Yeah, I was going to say Paul versus Trump, you know, transition from Gary to Paul, I think.
Right.
Opened the door.
I think we've seen the changes, but what that signaled was that the changes were going to come.
Right.
And so people, and again, the institutions we're working with, whether it's banks or others, all had a team. You know, the crypto team was getting ready to come online, but it was all, you know, in the shadows. Can't talk about it. It can't be public. What this allowed people to do is to come public and start reaching out to firms like ours and others to start
away a stigma.
to get ready. Correct. Yeah.
Interesting. So I just want to talk a little about ETFs or ETPs or whatever we call them. All your businesses touch on them in different ways. So I think what's interesting about them is obviously there's been a huge boom, and that's part of this institutional story. But like the original concept of crypto ETFs was, oh, it's really hard to trade crypto, and I don't know how to set up an exchange or whatever. So we need this ETF. As it's sort of getting a little bit easier for people to just exchange crypto directly, and then some people say that the ETF prices aren't as good as spot prices. I mean, where do you see ETFs going in the future? Well, you actually
I'm happy.
That's your business, yeah.
Yes, happy to jump in a little bit here, but just to give a sense. So when we're in, I have some people say it's hard to read the label when you're inside the bottle. So when we're in the world of crypto, you're like, why are ETFs so revolutionary? What makes it easier, right?
Exactly,
so when you're just buying on an exchange, that's one thing. But when you understand the institutional mindset, policies, procedures, investment committees, and how they function, they were groundbreaking in multiple ways because it removed for some, it removed the compliance complexity and allowed it to be an investment decision. That was one. The second thing after that is it's vehicles that wealth channels and others understand. So how am I going to custody this? How am I going to generate reports? How am I going to advise and report on all this for my clients? ETFs function in your normal accounts. And so it simplifies the world. So then all of a sudden, the wealth channels, the advisor channels, the RIAs, et cetera, could start at least having that discussion of getting that ETF onboarded like any other ETF and starting to decide how does this fit into model portfolio. So they are bringing innovation, although, for us in a financial way, to unlock more wealth to come into the space. That's how we see ETFs, is democratizing access and bringing vehicles that the masses understand and that fit investment committees.
Yeah, I would say, so on our side for the wealth management, a lot of people have a lot of money in 401ks or other qualified accounts that are tax deferred or tax advantaged. A lot of employers are incentivized to allocate to those accounts and provide those for their employees. And there was a big friction, right? We hear just recently now we have the ability to go direct into crypto with 401ks the other day, but prior to that, ETFs were really kind of the only way that you could get that exposure inside of those accounts. So, kind of moving forward, I do think that the main changes that we're going to see, and you guys are talking to me about this backstage, but like indexed products where you have weighted ETFs with multiple assets in them, so you have a diversification of exposure inside those products. I think that that's going to become much more prevalent versus just a single asset ETF.
Yeah, I mean, we're a bit different. Europe doesn't really have ETFs. A lot of their structured products are an exchange-traded product format where you're getting exposure to the underlying on a one-to-one basis. So we're primarily focused on issuing ETPs, wrapping the underlying asset in ETP form, giving you one-to-one exposure. We have roughly 78 different products as of today with close to 60 different single digital asset underlines, which effectively makes us the most diverse digital asset manager globally. And we'll look to issue those ETPs or cross-list them into new and emerging markets like Africa, Asia, Middle East, Latin America. We aren't particularly keen on coming to the US and competing with the likes of BlackRock or Fidelity, but there is a lot of opportunity in these new and emerging markets who want regulated exposure to digital assets because they don't currently have them. We are being asked by regulators to come and offer these types of products. And then in Europe specifically, they've been offering digital assets in a regulated fashion since 2015. So Europe is pretty much a decade ahead of anybody in North America. And with new MiCA regulations, they're continuing to advance. And I think you'll see the US continue to come along and then other developing areas that I mentioned as well.
I think there's a conversion that's going to happen. It's going to happen a lot faster than people think. So there's the TradFi, and then there's the crypto wealth, which Jake and his team serve extremely well. And so as an asset manager, we focus in those two markets. So on the TradFi side, like we were mentioning, you have traditional platforms, asset managers, and banks looking to figure out how this will fit in their wealth channels, portfolio construction, training the advisors. These are things that we're helping with. At some point, once they're comfortable with that, and they are coming, I could tell you, then they'll want to get into how do I bank the client beyond just wealth. So, I need to be able to custody those assets. I need to be able to offer banking services against those assets, because today, most of them don't. So that's going to bring TradFi into the crypto space for people who don't have exposure, that will get it through their wealth channels, and then bring in the crypto wealth. And then today, we're seeing specialized firms focus on crypto wealth. So all of a sudden, you wake up one morning with 100 million, 200 million in your ledger wallet, and you don't know how to structure the tax. You don't know how to structure basically anything for family trust, et cetera. You want to earn a yield on this. You want to diversify. This is where you're getting specialized firms getting up and running to serve as this crowd. Those worlds will collide in the coming 18 months.
Yeah, just adding briefly on that, one of the big things, governments really want to adopt regulated structured products, ETFs, ETPs, so that way they can get the tax benefits of it.
Yeah.
Interesting. So actually that kind of segues into my next point that Pascal just alluded to. It's like, what do you see as some of the biggest sort of pitfalls or mistakes to avoid, when you're kind of advising on management? I mean, either on institution or retail or whoever, like what are some of the big just mistakes, the most common mistakes, or the kind of craziest mistakes that you've seen people make that, and that sort of leads them to hire people like you to avoid those?
We talked about this a little bit earlier, but let's say you set up a trust, right? And you don't have an institutional custodian that's multi-sig and can build governance into who can sign what for, an exchange or buying or selling or removing assets from a wallet. It's kind of crude, but in the past, people have written those keys down on a piece of paper, torn them in half, deleted the wallet, and then given their trustee half the keys. And so anytime you want to do something, you've got to bring those two back together and reconstitute that wallet. I don't know about you. That's not my favorite way to play the game. So we provide an institutional way to be able to do that that's compliant and has all that governance and those things in place. And, there's a point to freedom, right? Like people might want $1 million on a cold wallet that they can just put in their Faraday bag and jet out if something bad happens. I get that whole side of things, but when it comes to your generational wealth and passing this to your children or maintaining it within your estate, even diversifying across jurisdictions, you could have multiple custodians inside different entities or structures in multiple jurisdictions. I think that this is going to become much more prevalent now that we have institutional custodians like Anchorage and Zodia and many others that are across the world. I think it's becoming much more prevalent, at least for high net worth individuals and family offices as far as we're working with.
I still think some people would think it's asset selection, but I wouldn't say that that's the case. I would add to what Jake said. It's the operational complexity people still don't understand, both at the TradFi side all the way to the most sophisticated family office, whether you're dealing, I remember a few years ago meeting with some CIOs who didn't know the difference between a North American-based ETF, a private, a closed-end fund, or an ETP issued in Europe. And they're like, oh, tell me the difference between your product or 21 shares or Grayscale back before it was an ETF. They just didn't even understand the structure and the risks relative to NAV, or how a debt note is structured in Europe versus bankruptcy remote ETF in the US. So all these things now need to continue to educate on the crypto side, how things are custody, et cetera. And even on the hedge fund side, which we deal with, we still see a lot of people focused on returns, which are important, but don't understand the operational risk they may take with certain LPs. They don't understand the difference between a fund-to-fund versus a managed account. So these are all things that still bring risk into the space. So that's why working with regulated entities like us and others, really bring that excellence so that you understand that it's capital preservation first through operational excellence, and then seeking performance through returns.
I want to touch on counterparty risk.
Yep.
Right. So you asked for mistakes that I see other people make. So let's say you do put your assets into a DeFi protocol. Cool. Like I'm all for DeFi, but you do have exposure there, right? That smart contract could be hacked. Are you actually giving up the assets, or are you reflecting it? with them. We have the capability now for you to maintain ownership of those assets and reflect that value with the counterparty so that you're mitigating a lot of that counterparty risk. There's still exposure on things, right? But at the end of the day, you want control of those assets and visibility on them, and if they're being rehypothecated or, you know, a bunch of the stuff that's been done in the past, you would like to be aware of that. So I think a lot of people, they don't even know that those things exist. They think that they're going to have to give up their assets in order to generate a return.
That is the biggest change in the past 2 years that, you know, that we pushed to help innovate. But since FTX, if people are asking what's the difference between then and now, it's the maturity of the operations, and understanding what you have access to is critical.
Yeah, BNY talked about margin against these assets. It's still very nascent. There's not a whole lot of people that will provide it and do it. Most of them are on the Web3 side, but the banks are coming. They were on the panel, they were talking about it, and so there's some larger prime brokers and other people that we've had conversations with that I do think will be willing to lend against these assets at very reasonable LTV or margin, so that you can orchestrate the stuff that we're discussing.
Yeah, I don't really see, I haven't seen any mistakes. It's more so, I think the biggest obstacle still to widespread adoption is to specifically all the alts, is a lot of fund managers or portfolio managers that I talk to, they're just wrapping their heads around Bitcoin, Ethereum, maybe Solana, but all the other alts, most of the questions I get are, so are these just meme coins?
Yeah.
Do they have any utility? There's still the misnomers that they're not generating any revenue, there's no cash flow, there's no businesses on these chains. So it's so that is the biggest obstacle I face when talking about the utility and the case to invest in altcoins and other digital assets outside of Bitcoin and Ethereum. So we have a lot of work to do on that front.
Yeah, well, Curtis, that's actually a really good point. I want to follow up on that for a moment because, you know, I have friends all the time asking for like crypto advice, investment advice, and I don't go near it because I don't want that liability, you know, especially, I mean, you know, everybody knows that crypto is volatile, but once you get into the alts, it's like you really don't know. You really don't know. I mean, there's been very surprising things that have happened. You know, the alts that people thought this is going to the moon, and then it just doesn't. You know, I mean, how do you just deal with that? Because it's, you know, again, when you're looking at, and I know this is sort of like a TradFi perspective, but when you're looking at crypto versus equities, you know, people argue, well, with equities you do have, you know, things you can look at, right? You know, that indicate future performance. Crypto can be a little bit of a crapshoot, especially when you get into the alts. So yeah, I'm just curious, like how you guys deal with that.
So we're right now, we have, for one of our clients is a top 5 Canadian bank, and we have to train thousands of advisors, and they're not going to go through a 6-week boot camp on the different, it's just not going to happen, right? They have other products to sell. So how do you simplify it? It has to keep it simple, stupid. And I'm not saying it's the only method or right method, but the way we try to educate that without going too deep into the technology, we'll do basic, you know, sort of blockchain boot camps, but fundamentally, what is Bitcoin serving in terms of digital gold for a digital age, and, you know, a macro hedge into your portfolio? Your layer ones, right? So your Solanas, your XRPs, your ETHs. I think right now what you're seeing with Circle's IPO and the Stablecoin Act is an easy reference point. You don't need to understand how it all works. You're just saying, are you bullish on stablecoins and what you're hearing in the news? Oh, yes, I am. That needs to be settled on a layer 1. Then you ask them, are you bullish on RWAs? I know you are. That needs to be tokenized on a layer 1, so they get the value prop. And then everything else, we just tell them it's liquid venture. Because they're still scaling, they're still proving themselves, and so just treat it as liquid venture in your portfolios. And so just don't label crypto as being all the same. And then when we explain it that way, I could pitch this in 15 minutes in a room, and they know how to position it with our clients.
Yeah, you have to use analogies. I like the liquid venture analogy, right? And if you can relate it to things that they, like, again, digital gold, they can think about that in their mind. So, the analogies and the education, to your point, I think we're still a little ways away from people actually comprehending everything that goes on here, and they really don't need to.
We go too deep. The industry goes too deep on the technical side.
It's just such a different way of thinking, though. Again, because when you look at like people who advise on just traditional stock markets, right? There's like certain, you know, criteria that people look at for advice. You know, you should invest more in this, you should diversify into that, because they look at the earnings. You know, like crypto is just such a different field. So I always wonder how people deal with that from an advisory side.
I mean, we look at partnerships, we look at use case, we look at total addressable market cap for the problem that they're trying to solve with the blockchain, right? So I'll give you an example. Let's look at Provenance, right? They have a bunch of tokenized real estate on chain. They have these mortgages that they roll up and do collateralized debt obligations, $750 million a month through Figure. That makes sense, right? You could also look at the insurance that's been tokenized on that chain. There's, $8 trillion in insurance globally. Only $225 million of that asset class has been tokenized on that chain. So if you really want to dig into the utility and the metrics, it's there. I don't think that actually affects the price of these assets.
Right. Well, that's kind of the point, yeah.
Right, so there might be some actual utility taking place on these networks, but it's not driving the price. Most of the price is driven by the speculation in the market, and then also by Bitcoin, right? You have...
My tweets.
Well, Elon, look at Doge. So until the asset class matures beyond, we're at 4 trillion. We just crossed 4 trillion.
Yeah, 4 trillion. Right.
That's what I'm talking about. But when we're not even close to gold. We're 1/3 of gold globally. So I think we need just a lot more adoption and liquidity before you can start putting the same type of metrics around these assets.
But it won't necessarily be the same metrics. It'll just be a different way of doing analysis of,
exactly.
Just like how you analyze a different stock, tech companies are valued different than utility companies, right? So it will just become part of, I don't want to say securities analysis because they're not securities, but what I'm saying is it will become part of traditional wealth analysis and how it fits in a portfolio.
Yeah.
I think the tokenization has certainly helped the narrative and given people that one big example of a killer app that's being built on alt chains. The Bitcoin is a proof of basically a store of wealth, whereas Ethereum, Solana, a few of the other alts, that's where the real technology is being built. That's where the rails for the next generation of liquidity and the financial system is being built. So as that ecosystem continues to mature, people will be able to really see of the wealth and the value that's being built on all of these other chains. And tokenization and stablecoins were the first big example. Somebody said it, I don't know, on Twitter, I think it was crypto's ChatGPT moment.
Mm-hmm.
And so now that's really helped the conversations we've at least been having with fund managers and portfolio managers. Well, look, I relate it back to my early career where I started my first businesses in the high-tech bubble. And people, when Google and Facebook and all these IPOs came to market, people were saying that I miss the upside, right? Because I wasn't part of the VC game. If you bought Google's IPO and you ran it for the past 20 years, you did pretty darn well, right? And so I'm saying this because here we are answering questions that we know that this is coming into the space, but I still think we're early enough to a point where we're not going to see necessarily the 500x in a month, but I think we are circa 2003, 2004, where all these tech companies that were misunderstood, that were laughed at because a lot of them were hype and bubbles, became sort of today, without the tech sector, the S&P 500 is not staying afloat. And I think crypto is going to be that next leg of asset allocation in people's portfolios. So in my opinion, we're circa 2003, 2004, where the real players and the real technology is established, regulation is clear, it's making its way in. So you're still quite early. I think risk reward, it's a good time to enter.
We don't have too much time left, so I just want to get to one final question, which is basically your favorite strategies for generating returns.
Ooh, that's good. So I think you're going to get some different answers from this panel than you would maybe some other ones. He might have some good DeFi stuff, but so we actually don't use DeFi to generate returns for our clients. We use traditional methods. So kind of a have your cake and eat it too. You're able to, like I talked about, keep your asset in institutional custody, reflect that balance with the counterparty. They get a line of margin against it, somewhere between 60 and 100%, just depends on the asset. They trade, somewhere between 50 and 70% of that line of margin in a market neutral strategy. And so that way we're able to, look at past track records for these funds that have generated some pretty good returns. You're not, overexposing yourself to counterparty risk. The exposure, the potential losses, their losses for the strategy, but that's really the risk that you're running. And it's a great way to, maintain your long position with the asset, not have any tax implications, and then still generate some cash flow.
So for us, for sure, right now, the biggest draw is the market neutral strategies around pensions and large institutions. It's not necessarily gaining you crypto exposure, aka yes, you're using crypto or you're using the liquidity of and the disconnection in the industry to create a nice return. So that is definitely meeting the needs of institutions who are typically looking for market neutral, and the TradFi space has kind of dried up. So crypto is the next edge on that, and capacity is being built, and infrastructure is becoming more institutional. And then there's yield on non-yield bearing cryptos, where people who have got a lot of Bitcoin, a lot of XRP, et cetera, who cannot stake, they don't want to divest, they're looking at ways to generate income off of that. Again, the ecosystem and the infrastructure is becoming institutional enough to be able to do that without putting your assets at risk.
Yeah, personally, I'm kind of risk adverse, so I just buy the spot and I'll stake it if it's able to be staked. But in terms of our business, everything we do is leveraging yield in any way we can. We generate yield on our AUM, or assets under management. Like I mentioned, majority of our AUM is made up of the altcoins, so we can actually even stake our Bitcoin through a partnership with Core DAO. It's effectively a layer 2 on top of Bitcoin. They developed the first dual staking mechanism where you actually were able to self-custody your Bitcoin. You get paid out in yield via Core tokens. So we're able to generate revenue off of that. The company takes the yield on the AUM as revenue. We do have staking products that we offer to investors, but the spot products are still more popular. I'm not sure where the disconnect is, because it's almost risk-free yield if you're buying it through a structured product. But I think maybe some of the over-leveraged stuff that happened over the past few years may have scared people off and have shied away from yield strategies. But we'll see. But yeah, Europe, we're able to offer staking products. We generate yield off of our AUM. And then here in the United States, it looks like we'll have yield-bearing ETFs here soon as well.
It's coming.
Right now, we're sort of witnessing a real stablecoin boom, and there's new stablecoin regulation. Does that affect your businesses in any way that you're seeing so far?
Well, it helps make our institutional partnerships easier, because all of a sudden, all this regulation, this use case, people used to, look, we were talking to these institutions for years. When I say institutions, banks, asset managers, other partners, like big names. And it was always the same question was, I understand that the technology, what it can do, but where's the real use case, right? Mm-hmm. And so that's just a disconnect when the technology can do what it said it can do, but it was too early for market needs. And so now where we're at this sort of crossroads where the technology was always there, it's gotten more robust, regulations there, now the use case is clear, and so it's just opening the doors more. And so it doesn't transform the products we create, although yes, you can now issue things where you're gonna take stablecoins in kind, et cetera, but what it does do is it just gets the doors open to continue growing the space. That's for us anyways.
It just allows us to transact faster, right? So that yield, if it's paid in a stable coin, that person can go take it and do whatever they need to immediately with it, convert it to something else, or swap it and send it to their bank account. Payments, I think is the killer app for crypto at the end of the day, and the speed and efficiency that blockchain and a lot of these protocols bring to market with the stable coin and the issuance of that, I think is going to drive the velocity of money significantly higher, and it's almost, it's the lowest it's been in history. So we need that to be able to reduce M2 money supply and a lot of the other things that people view as bad. So I'm excited about stablecoins. There hasn't been like an immediate effect on our business, but I would say, liquidity and speed for transactions, tokenized money markets, that we're up here talking about that a little bit earlier, swapping back and forth from a stablecoin into that. I think just, liquidity and speed is a big deal in the industry, and it's going to be great for us.
See, I think there's opportunity now for us to make strategic investments in stablecoin companies. You have Tether, and then as well as a few upcoming companies that will be launching yield-bearing stablecoins, and that's an opportunity for us to potentially commercialize and then implement those stablecoins into the plumbing of our operations. For example, if somebody launches a yield-bearing stablecoin, we could effectively wrap that in an exchange-traded product and offer investors effectively risk-free yield. Depending on what that yield is, we can run it through our OTC trading desk, where we, Stillman Digital, we're doing a couple of $1 billion a month in trade flows, and get additional yield and fees off of that as well. So it's just, really opening up additional liquidity and opportunity and access to players who weren't exposed to digital asset space before. And that's going to create a tremendous amount of wealth across the space.
That seems to be the consensus. So we only have about a minute left. Anything else anyone wants to say that you didn't get to say?
I was just going to go back to the mistakes, and you guys, I would be interested in y'all's opinion on this. I think market cap, people look at market cap and they go, oh, you can't have, trillions of dollars in market cap in these networks. I think people are going to be very surprised by what the market cap from these networks go to, because they're used to looking at it like a stock, where all of those shares are traded. But circulating supply and available supply, or total supply of a token, are very different.
Right.
And I think that constraint is hard for people to reconcile in their mind. And I'm excited to see some of the market caps of these digital assets far surpass, these trillion-dollar companies that you're used to seeing on the stock market.
Well, that's a good point. I keep telling people that it's the first time in history where the technology is also the asset, and that's where it gets hard, because like you're mentioning, total value locked. If we were to say, X asset manager, manages trillions, no one blinks an eye, these networks can essentially do this.
Exactly.
Yeah, you're bang on.
Okay. Well, thank you so much. Thank you. That's good.
Thank you.
Thank you.
Thank you.